Have you ever heard someone claim that Islamic finance is inherently riskier? Or, that its religious rules just don't allow for real wealth protection? It's a common misconception, honestly.
It really is. And that idea, I think, stems from a basic misunderstanding of a system that's actually built on principles designed to safeguard investments, not block them.
Okay, right. Let's unpack this then. Today we're doing a deep dive into a really important and, often misunderstood area. How Islamic finance manages and hedges against investment and financial risks. Our mission here is to walk you through the Dubai financial market's detailed standard on hedging, sort of dissecting its rules, its mechanisms, and some really groundbreaking alternatives to conventional tools.
And that's an excellent source to use for this. The DFM Standard is it's comprehensive. It's an official document clarifying Sharia-compliant practices. Think of it as a blueprint.
Absolutely. And for you, our learner, get ready for maybe some surprising aha moments. This deep dive, I think, will reveal how a financial system, one deeply rooted in its core principles, actually prioritizes wealth protection in ways that might even challenge some, conventional ideas about risk management.
Definitely. The why of Islamic hedging, it really starts with a foundational duty in Islamic Shari'a, the protection of wealth. It's a core objective. So when Islamic banks and financial institutions handle funds, say through contracts like wakala or mudaraba, they're typically acting on a trust basis.
And that's a crucial distinction, isn't it? So if you're a fund manager in this setup, you're generally not held liable for losses unless there's clear misconduct or negligence or you breach the agreement. It's not like you're guaranteeing a return. But because safeguarding those funds is such a core duty, hedging as a way to achieve that protection becomes a duty itself, if that makes sense.
Exactly. And this leads us to a really important point. The difference between protecting capital and actually guaranteeing it. Protection means, taking sensible measures to reduce the chance of loss, but those measures might still fail. Like putting a lock on your door, it protects, but it doesn't guarantee against a determined thief. Guarantee, on the other hand, means you promise to bear the loss no matter what. It's an absolute commitment.
So when these institutions use trust-based contracts like mushraka or mudaraba, they're aiming for protection, not a guarantee. And that difference relieves the manager from guaranteeing the funds, unless, again, there's that misconduct or negligence. That's a pretty fundamental shift in liability, right?
It truly is. And what's fascinating here is how Sharia inherently links profit directly to taking on risk. There are these two foundational maxims. One is profits and risk-taking are interdependent. Al-Kharaj by al-Daman. Basically, whoever bears the risk of loss gets the potential profit. And the other is profit accompanies risk of loss, al-gun by al-Gurm. It's a core principle. You have to accept the possibility of loss to earn legitimate profits. No free lunch, essentially.
That's such a powerful idea. It implies a very different view on risk from the outset. But, okay, while risk-taking is inherent, certain risks are completely off limits, things that would just invalidate a whole transaction.
Yes, absolutely. We're talking about things like excessive uncertainty, Gharar Kabir. This isn't just normal business uncertainty. It's ambiguity so significant it undermines fairness. Then there's major ambiguity, Jahala Faisha, about key terms. And, of course, usury, riba. Anything involving interest. These are strictly forbidden because they bring in exploitation or pure speculation, which Sharia doesn't consider legitimate ways to profit.
And this whole framework finds a pioneering home in the Dubai financial market. The DFM is pretty unique. It's been operating on Sharia principles since 2007, the first globally. So this standard we're digging into, it isn't just about compliance for those already in the system. It seems designed to clarify misunderstandings and maybe even encourage conventional players to look at Sharia-compliant approaches, a real leader.
Definitely setting a standard, quite literally.
So if Islamic finance operates with these strict principles, how does it actually do hedging? How does it manage financial risks in practice? It must require some pretty creative solutions.
It certainly does. The standard lays out broad categories of lawful instruments. You can think of them as different ways to provide security or assurance. There are personal guarantees, in-kind guarantees, independent ones, contractual ones, and even some compound mechanisms that mix and match.
Okay. Can you give us some examples? What are some specific contracts they might use?
Sure. Traditional collateral contracts are key. For instance, kafala. That's like adding a cosigner to a debt. A guarantor adds their liability, so you have two people responsible. Then there's ran, which is basically a mortgage holding property as security against a debt. And hawala, that's a debt transfer. It allows shifting a creditor's right or a debtor's obligation to someone, usually someone more financially sound. These are all about protecting rights through clear commitments.
Okay, those sound somewhat familiar. But then we get into contractual options, and this is where it seems to get really interesting and maybe distinct.
Yes, this is where some unique Sharia-compliant tools come in. There's Khiyar al-Shart. This gives one or both parties the option to cancel a contract within a specific agreed time frame, like a cooling-off period, built in. Then you have Khiyar al-Nok. This is the seller's option. They can cancel if the buyer doesn't pay the price on time. Pretty straightforward, but a useful protection for the seller.
And what about that urban sale, the down payment option? That one sounded particularly clever.
Ah, yes, Khiyar sale with urban. Very interesting. The buyer makes a down payment, the urban, to reserve the right to cancel the purchase within a set period. If the buyer cancels, the seller keeps the down payment. If the deal goes through, the down payment becomes part of the purchase price. Standard so far. But here's the really unique part, the aha moment you mentioned. The standard explicitly says this right. The option itself can be transferred to someone else only once.
Only once. Okay, that's fascinating, because that immediately stops the kind of secondary market speculation you might see with conventional options, doesn't it? Where the option itself gets traded multiple times.
Precisely. It allows for a legitimate reservation, a genuine need for flexibility, but prevents that option from becoming a tradable commodity in itself. It keeps the focus on the underlying asset or transaction.
That is clever. Protection, but with an anti-speculation break built right in. What about penalty clauses? Are they allowed?
Generally, yes. The DFM standard says penalty clauses are valid in most financial contracts except for debt-based contracts. That's the key exception. So they're okay in things like istisna manufacturing or supply contracts and in labor or lease contracts. But there are conditions. The penalty amount must be fair, and the delay can't be due to something completely outside the party's control, like a natural disaster.
Right, so a penalty for late delivery of goods is fine, but you can't just add an extra penalty charge onto a late loan repayment if it's already a debt. That makes sense with the no riba principle. Beyond these contract-specific tools, what are some more direct forms of hedging outlined in the standard?
Well, one mechanism is the investment risk reserve. This involves taking a small deduction from the investor's profits, importantly, not the fund manager's share, and setting it aside in a reserve. This reserve is specifically to cover potential future investment losses. If it grows large enough over time, it can actually absorb significant losses without eating into the original capital.
Okay, so the investors collectively build a buffer from their own potential gains. What about that third-party guarantee you mentioned, the one with the donation aspect? That sounds very different.
It is quite distinct. This is where a third party, someone separate from the main contract, like a partnership or a mudaraba, voluntarily commits to cover potential losses. They do this through what's termed a donation, tabaru. And crucially, this guarantor has no right to claim reimbursement from the fund manager if they have to pay out. It's a one-way commitment.
Wow. So it's like a charitable backstop, almost.
Yeah.
Someone steps in voluntarily to shield the investment pool.
That's a good way to put it. The International Fiqh Academy, which is a major authority, has clarified this. They stress there should be no formal link tying this guarantee to the main investment contract. And they point out it's not a real guarantee in the conventional sense because the invested money in mudaraba or partnerships isn't considered a debt that must be repaid. It's a voluntary undertaking to make good on a loss, which is, a very different philosophy of risk mitigation.
A safety net provided out of goodwill, essentially, without creating new debt claims. That really shows the principles at work. And, of course, the manager is liable if they mess up, right? If there's misconduct or negligence.
Absolutely, that's non-negotiable. If it's proven that the fund manager engaged in misconduct, was negligent, or breached the terms of the agreement, then they are liable for the losses. That includes loss of capital and even potential lost profits. Their role shifts from being a trustee, amen, to being liable because they violated the trust.
Okay, that makes sense. And finally, under direct hedging.
We have takaful insurance. This is the well-established Sharia-compliant alternative to conventional insurance. It's based on mutual cooperation and donation. A group of people facing similar risks contribute to a shared fund, and that fund is used to cover losses suffered by members of the group. Mutual support.
Right. Now, this brings us to a really fascinating area. If conventional derivatives, things like futures, options, swaps, are often seen as problematic under Sharia, maybe due to speculation or uncertainty, well, how do Islamic institutions handle complex market risks? This must be where the innovation really kicks in.
It absolutely is. Let's take futures. Conventional futures contracts, especially those settled in cash without any actual delivery, are generally not allowed. The Sharia alternatives have to be based on real transactions involving actual goods or assets. So, they might use credit sales where the goods are delivered now, but payment is deferred. Or the opposite, a salam sale.
It's a long sale. That's where you pay up front.
Exactly. Price paid in advance, but the delivery of the goods, which must be clearly specified, happens later. The key in both cases is that a genuine sale of a commodity is intended, not just a bet on future price movements.
Okay, so it anchors the transaction to something real. What are conventional options, also generally impermissible?
Yes, typically because buying and selling the right itself for a premium is seen as potentially speculative, detached from a real economic activity.
So how do they get the flexibility that options provide? Like locking in a price or having the right, but not obligation, to transact?
They use the tools we talked about earlier, like the urban sale, with that unique transferable only once rule that acts like a down payment option tied to a real purchase. There's also Khiyar al-Shart, the mutual cancellation option within a contract, but that option itself isn't separately tradable. And importantly, they allow for binding promises, a promise to sell or a promise to purchase something in the future. But, and this is critical, these promises must be unilateral, one-sided commitment, or bilateral but free of charge. The promise itself cannot be sold, and it's generally non-negotiable or transferable.
Ah, okay. So you can make a binding commitment, but you can't trade the promise like a commodity. It has to stay linked to the intended underlying transaction. That's a very clear line they draw.
It is. It prevents the promise itself from becoming an object of speculation.
What about swaps? Things like interest rate swaps or currency swaps are huge in conventional finance. How are they handled?
Again, conventional swaps, especially interest rate swaps, are impermissible due to riba. The Sharia alternatives have to be structured differently, often involving bilateral promises linked to actual permissible transactions. For example, two parties might make binding promises to each other to execute two separate mubah sales, cost plus financing, in the future. Maybe one sale is in one currency, the other in another, effectively hedging currency risk. Or one sale might have a fixed profit rate, the other variable mimicking an interest rate swap effect, but through permissible sale contracts.
So it's about cleverly structuring multiple legitimate transactions to achieve a similar economic outcome to a swap, but without using the prohibited mechanisms.
Precisely. It requires more structuring work, but it ensures compliance.
Then there are indices, like market indices, obviously important tools. How are they viewed? What are the rules around using them?
Right. Indices are statistical measures. The standard is clear on what's not allowed. You absolutely cannot trade indices based purely on their numerical changes. That's just speculation. You also can't use options based on indices. And a very important point, you can't link monetary debts, like loans, to a price index as a way to hedge against inflation or currency fluctuations. That's seen as potentially leading to riba.
Okay, so no trading the index itself or using it to adjust debt values. But they can be used in other ways.
Oh, yes. They are very useful as measurement tools. It is permitted to use indices, say, to evaluate the performance of a fund manager against a benchmark, or to assess the overall risk of a portfolio, or even for market forecasting, just as analytical tools. They can also be used as a benchmark in investment funds, or sukuk, Islamic bonds, to help determine performance fees or incentives for the manager.
And what's the rule if you use an index to help determine profit in a sale contract, like murabaha?
The crucial rule there is that the final profit amount in the contract must be fixed and determined at the time of the contract. It cannot fluctuate based on future changes in the index after the contract is signed. The index can be a reference point before finalizing, but not a variable after.
Got it. And they can be used for setting variable rent and lease contracts, too.
Yes, that's generally permissible as long as the underlying lease contract itself is Sharia-compliant. And of course, for an index to be considered an Islamic index, it needs to meet certain criteria. It has to reflect genuinely Islamic investments, meet Sharia and technical standards, have its own Sharia supervisory board overseeing it, and be reviewed regularly, usually annually. It ensures the benchmark itself aligns with the principles.
Okay, that makes sense. Now, let's tackle what seems like one of the trickiest areas: currency hedging. You mentioned conventional currency hedging often involves forward contracts, which are problematic because Sharia generally requires immediate delivery, or at least within a short settlement period, for currency exchange.
That's the core challenge. Foreign exchange transactions under Sharia should ideally be spot, meaning The exchange of the two currencies happens immediately or within the standard settlement period, like 2 working days if the parties are in different places, T+2. Forward currency contracts fixing a future rate are generally not allowed because the delivery of both currencies is deferred.
So if forwards are out, what do Islamic banks actually do to manage the very real risk of currency fluctuations, especially in international trade or finance?
This is where the standard provides some fantastic practical examples of that structuring ingenuity we talked about. Imagine a bank needs to pay a supplier in US dollars in, say, 3 months for a commodity it's buying. To hedge against the dollar strengthening, the bank could at the same time secure a binding promise from a different client, a Mirabaha customer, to buy that same commodity from the bank in 3 months, but priced in euros at an agreed euro-dollar rate.
Okay. So the bank locks in the euro inflow needed to make the dollar outflow, using the commodity transaction as the bridge.
Exactly. They're not directly trading future currencies. They're structuring 2 legs of a commodity transaction in different currencies that offset each other's risk. It's quite elegant.
That is ingenious. What's another scenario?
Okay, slightly different situation. A bank buys a commodity with payment due in euros in, say, 60 days. It immediately sells that commodity to a local Mirabaha customer for UAE dirhams, payable immediately. The bank now has dirhams, but needs euros in 60 days. So it could use those dirhams today to buy a different commodity, maybe metals or something, and simultaneously arrange another Mirabaha sale of that second commodity to a different client, this time priced in euros, with payment due in 60 days, matching the date the bank needs to pay its original supplier.
Wow, okay, that's like layering 2 separate permissible commodity deals to synthetically create a hedge for the euro-dirham rate over that 60-day period. That takes some serious planning.
It does. It shows how they achieve risk management objectives by working within the framework of permissible contracts involving real assets.
Are there simpler ways, too?
Yes, sometimes the solution is simpler. The bank could just ask its client to do the Mirabaha deal in the same currency the bank used to buy the goods from the supplier. That eliminates the currency mismatch for the bank entirely. Or if the client needs a different currency, the bank might simply increase a profit margin on the Mirabaha sale up front. They'd explain to the client that this higher margin accounts for the potential risk of the currency moving against the bank. In that case, the client effectively bears the exchange rate risk, but transparently.
Okay, so several options ranging from complex structuring to simpler risk transfer. What about just general liquidity, making sure the bank has cash flow without resorting to interest-based borrowing?
They use instruments for that too. Salam sales, paying cash upfront for future goods, brings cash in early for the seller. Another technique is selling an asset the bank owns for immediate cash and then leasing it back over time through an Ijara Muntaya Bitsamlik contract that's a lease that ends with ownership transferring back to the lessee, the bank. It provides immediate liquidity from the sale. And structuring investment portfolios so that a certain portion, maybe at least 10%, consists of tangible assets. This can help with liquidity because units representing those tangible assets might be easier to sell if needed.
Okay, the DFM standard seems incredibly comprehensive. It also maps out the whole landscape of risk, doesn't it, beyond the market and currency risks we focus on?
Yes, it covers a wide spectrum. It defines credit risks, which is the classic risk of someone failing to repay a debt or meet an obligation. Market risks covering price fluctuations, exchange rates, profit rates. Inflation risks, the decline in money's purchasing power. It even includes contract drafting risks, the danger of loopholes, ambiguities, or information asymmetry in the contracts themselves, and broader economic risks like political instability, changes in government regulations, that sort of thing.
And what about moral hazards? That sounds like it gets into behavioral risks.
Exactly. Moral hazard risks pop up when assets are managed on behalf of others, and there's an information gap. For example, a fund manager, Mudareb, might take on excessive risk, contrary to the investor's expectations because they don't bear the full downside, or simply dealing with individuals who aren't trustworthy. Now, Sharia accepts that ownership itself carries inherent risks. That's the Al-Kharaj by Alderman principle again. But it does validate hedging against these moral hazards through tools like takaful insurance, requiring collateral and ensuring proper diversification to spread the risk. It's about managing the human element.
Okay, so if we try to tie all this together, looking at the big picture of risk within Islamic finance according to the standard, what does it identify as the single most serious risk of all?
That's a really important point they make. The standard identifies the operational risk of non-evidence by Sharia requirements as the most serious risk an Islamic financial institution faces.
More serious than market crashes or credit defaults. Why?
Because failure to comply with Sharia can fundamentally undermine the very validity of the institution's contracts and transactions. If a contract is deemed non-compliant, it could be avoided. Even worse, profits earned from non-compliant activities might have to be disposed of, often channeled to charity, rather than being kept by the institution or distributed to investors. And of course, the reputational damage can be immense, eroding client trust. So Sharia compliance isn't just an ethical overlay. It's absolutely critical for the operational and financial viability of the institution. It underpins everything, including all the hedging practices we've discussed.
Wow. Okay, so what does this all mean for you, our learner?
I think our deep dive into this DFM hedging standard really shows something powerful. It reveals that Islamic finance, far from being rigid or somehow incapable of managing risk, is actually a remarkably sophisticated system. It actively mitigates and protects investments, but it does so while adhering strictly to its foundational Sharia principles. It finds ways within the rules. Precisely. I think the core insight here is that these institutions see protecting wealth as a profound duty. And they achieve this using a really diverse toolkit of lawful instruments, some traditional, some incredibly innovative alternatives that often run parallel to conventional tools, but operate on fundamentally different Sharia-compliant logic. They're finding solutions that fit the framework, not bending the framework to fit external solutions, if that makes sense.
It does. So maybe the final provocative thought for you, the learner, is this. Consider how this strong emphasis on ethical boundaries, on genuine risk sharing rather than just risk transfer, and the deliberate avoidance of pure speculation. How might those principles offer valuable lessons? Could they even provide alternative models for thinking about risk management in the broader global financial landscape? What new ways of thinking about financial safety, stability, and even growth might emerge if we took some of these underlying principles more seriously? Something to think about.